Hey guys, I'm the Newb investor. Today, unfortunately, will not be screening stocks, but I will attempt to answer why I think stocks trade at different PEs. I thought of 4 different reasons why, and I will discuss them with you by associating examples of stocks you may have heard of. Reason number 1, their financials. As you may have seen from my previous videos, my three metrics are very heavily centered on the PEs. Among other investment channels, you may say my screening technique is way different from all of them. I don't deal with that magic, messy, and guessing game of projections. That will be a topic for another video, but seriously, if you look closely at my second metric from my previous videos, you'll see why stocks trade at different PEs. We'll take Visa as an example, but before I reveal their financials, I want you to think, why is Visa trading at high PE? Let's confirm the theory. If you Google Visa and check their PE, you'd see that it's trading at around high 30s to low 40s. Now, compare that to their financials. This is from my second metric. Look at their net income and free cash flow yields. You can see that it confirms those PEs it's trading around at. Let's do another perspective. Let's put ASML's financials next to Visa's. They have different yields as expected, right? Say, you take off their names. Let's rename them X and Y. Note that their yields stay the same. Now, assume that we don't know what company, what sector, and what they do. Let's just focus solely on these numbers. If they both made a revenue of $100 billion, obviously the higher yield would make the most money of that revenues, and only logically therefore, we should pay a higher PE to companies with the most yields. Now, this theory must stay true to all stocks, regardless of sector and regardless of what they do. This is why I always say in my second metric that we want to pay $1 or less for 1% of the money they're making. This is saying that we want to buy stocks at fair or discounted prices. This is also true when the company decides to cut costs and expenses to increase their yields, or when the company decides to further the company by spending more and cutting their yields. Reason 2 is revenue growth. My second metric isn't as foolproof as you may think, because the metric doesn't account for the values of those revenues. The companies would still make the same yields with decreasing revenues. That is why it is important for companies to at least maintain or retain the growth of their revenues. But for stocks with consistent accelerating growth, bullish investors would pay a multiple, a premium perhaps, which ultimately bring the PEs higher. High-yielding and fast-growing companies often have high PEs due to multiples. This is betting that the company would crush the estimates analysts had assigned for them. In time, their fundamentals should catch up with their financials, or a bubble would burst. Let's take Nvidia for example. This is one of those stocks with high yield and very fast growing companies investors take a bet on. You'd see here the multiple for growth investors are paying for. High growth potential, the higher the PE. Reason 3 is market sentiment. Everyone wants easy money. That's why people chase growth and forget stocks that hasn't done much in a couple years. People don't want dead money. This is the third reason why. The overvalued, the hype, and the forgotten stocks. Let's take Coca-Cola, Palantir, and Intel. Just from the charts, you can tell already. KO is overvalued in all of my metrics. Still, it's trading at high PEs because of their yield, but also because no one is selling the stock. But in perspective of their revenues, nothing has changed much. And they still pay a hefty load just for dividends. There's a clear disconnect between the stock price and their financials, but people buy them anyways. Palantir was overvalued then, yet still made the most movement than INTC or Intel, which hasn't made highs since the boom. The market sentiment also plays a huge role with the PEs. Overvalued, more hype, higher PE. Dead money, forgotten stocks, lower PE. Reason 4. Index weighting. Index weighting is also a reason for this. Most people who buy ETFs pay lesser for the least weighted sectors in an ETF. If you use SPY, VOO, VTI, and their weighting, we can say that telecom and basic materials benefit less from this compared to tech and healthcare. Now, if we look closely at these specific stocks like AT&T and Dow, they will trade with lower PEs even compared with companies that literally makes no money. Until people stop buying ETFs and focus on buying individual stocks, some of these sectors would remain undervalued. These are my 4 reasons why I think stocks trade at different PEs. What are yours? Let me know in the comment section below. Before I end the video, I just want to say thank you to my 10 subscribers. The very few people of many who thinks I make sense from all these numbers and boring videos. I hope we continue to grow more and reach more people so I can help them buy and accumulate stocks at the right prices. Let me know what stocks you want me to screen in the comment section below.